Hi, thanks for tuning in to our Practical Nerds weekly podcast. I'm Shub, and together with my partner and co-host Patric, we normally invest in founders in design, construction, renovation, and logistics technology. Many of our friends in the ecosystem wanted us to start a podcast on the built world, and in return, we decided to honor their request with a show about nothing at all. Patric, been a bit of a while since we did one of our nice episodes at Practical Nerds. How have you been?
Fantastic. How have you been?
Cannot complain, sir. But the interesting thing is, in the time since we did our last episode, people talk about changing world orders and whatnot, right? And I guess that's as good of a segue you'll get from me, Patric, for the topic that we were thinking about whether we might potentially be on the cusp of a changing order or changing landscape in the VC ecosystem as well.
I like that. Let me actually run with your metaphor. I know you are very long on oil call options.
Always.
Yeah. So VC is also well described as it's the art of buying long-dated call options in companies.
Well done, sir. Go. Well done.
Yeah, but what might change is who buys what kind of call options. So let me set the scene here. I think it's a straightforward problem and observation. And then what's really interesting is the not so straightforward conclusion from that, what might actually happen and what founders and VCs might actually choose to do with it. So here's the premise that I pose. And by the way, this is not something that you and I only, we have said it for 3 years. I think others have said it for 3 years too, then a lot more others for 2 years, a lot of people for 1 year, and then many, many people are saying it now. So I think it is becoming sort of a common wisdom that the venture capital industry is bifurcating. Bifurcating means the middle of the market is coming more and more under a squeeze. These are the 200, 300, 500, 700 million generalist funds. Also specialist funds when they exist in that, let's say, size range, but there are fewer of them. Mostly that is a generalist game in that size. And so what you have is at the most extreme end of the spectrum, platforms that raise 5 billion, 7 billion, 9 billion in AUM, and then oftentimes they allocate them into different kinds of pockets, but each pocket is still super, super large. And at the other end of the spectrum, you're seeing specialists that go extremely early. So, and I would count fundamental to that historically already and today more than ever, which means, hey, dedicate to leading or sometimes even for other people participating in pre-seed rounds and seed rounds, and have fund sizes which statistically allow you to actually return a much higher multiple on money than if you had 100 times the fund size. So we're not going to discuss why that is the case. That's something that is well documented, clear phenomenon. Just as a premise, we're using that. So this bifurcation is something that many people now in 2026, many industry observers are actually agreeing with. That means that the middle of the market is coming under a squeeze and has to sort of figure out how and where to compete. So far, that is the premise. Shub, have I forgotten anything?
I think you're absolutely right. I think one thing perhaps to add, just to complete the picture, which may or may not be relevant this time around, but nevertheless, for the two of us and our listeners to be aware, and we have mentioned this as well. So VC, even though we don't like to acknowledge it, venture capital also happens to be a very cyclical business, right? Not because we want it to be cyclical or it's designed to be cyclical, but the human sentiment, unfortunately, is cyclical, right? So we tend to go through these weird phases of ups and downs, which tend to correlate with other things happening, either in the macroeconomy or with excitement for new technologies and things of that sort. But I think what, at least to me, feels a bit different, if you limit yourself to just, say, 1 or 2 phases of the cycle, venture capital is particularly notorious for also always choosing to be in a state of amnesia, where we always forget why the previous cycle happens, and then we get started with the new cycle all over again.
I found it fascinating how Mark Andreessen actually explained that on Jack Altman's podcast. As you know, I listen to practically no podcasts, but I had once during a workout discovered Jack's podcast, and I have to say it is very, very good. And Mark said the following to that explanation. He said that another way to look at the job of the venture capitalist and capital industry is to constantly be in search and finding the next ultra large trend. And he claims, and look, he's a very good storyteller, of course, but I think he's also a great observer of the industry and then playing to the industry. He claims that since internet, even if you say cloud and mobile, sort of, but since the internet, the industry has been looking for something of a similar or larger magnitude, and then the job is to pile in as much as you can. So he explains that. Obviously, now he thinks it's AI, etc., and I can see why people think that is the case, etc. That's not the point. The point is, he says the reason why VC falls always for trendy cycles is because this is literally how VC searches for the next big thing.
Yeah, I mean, look, logically, it holds up. I think that the reason why this premise is important, and perhaps it's something for us to discuss, is whether we are at a certain point in a cycle, the observation you just made, or the hypothesis you laid out, whether it is a point we are in a cycle which will eventually revert to somewhere closer to the mean, or is it a structural changing of the landscape itself?
So I believe it is the latter. And now that we have the premise, the bifurcation of VC, there are people who come to a very logical conclusion about what they do. By people, I mean founders and investors. Let's split the two. So let's start with this very logical conclusion, and then perhaps you and I could debate what we actually think is a completely overlooked opportunity as a result of that. So what most founders and investors conclude from this very intuitively is, okay, money gets concentrated into fewer and fewer extra large potentials. And when you say potentials, because when you're, let's say, at the stage that OpenAI or Anthropic are, what was the latest Anthropic ARR number? 30 billion, I believe?
Yeah, that's right. Went from, I think, 9 billion to 30 billion in 3 or 4 months. Yeah.
So that is not, I mean, that is pretty incredible.
Yeah.
You have to admit it. And now at that stage, is the business model sustainable? I have never seen the numbers. I cannot judge. But if you just take it for now as whatever, it's a sustainable and highly substantiated business, then at this point, that late stage, the concentration of capital might be justified. You have to analyze it a little bit more deeply, etc., etc. But then the same, actually, people will say, and I agree with that actually as a conclusion, that even capital will concentrate in the earliest stages at most ridiculous multiples into fewer and fewer companies, because they could be the next one of the few ones that have perhaps a shot at $1 trillion outcome or $100 billion outcome. Yeah. So you have fewer and fewer managers that manage more and more capital, chasing fewer and fewer extra asymmetric outcomes. Late stage, probably justified at some point. Early stage, by traditional metrics, not justifiable, but justifiable by buying call options, long-dated call options, into the most asymmetric potentials. So what does that mean for founders? Well, for founders, that means that if you're one of these, raising will become very easy for you, and it can actually become more of a flywheel and more of an inevitability. That doesn't absolve you of building a real business. You will still have to do that. I'm firmly convinced of it. But the raising part of it will actually become easier, which is not normal. That is absolutely not normal. Usually your pre-seed and your seed is the easiest thing you will do as a founder. It's the easiest thing. So in these kinds of instances as a founder, if you're sitting on one of these opportunities, that's how it might feel like. Good for you. And here's the thing though, as an investor. So if you're now one of these super large platforms, we literally just said what they're going to do. But Shub, what are now other fund managers that sit in the middle or maybe at the bottom of the capital per fund stack? What do people say these guys are doing now?
So just to be clear, so when you say middle, are you referring to the middle stage?
No, 200, 500, 700 million per fund. So like the middle tier.
Yeah. So I see them going into possibly one of 2 or 3 modes. One mode is they do whatever it takes to participate in a company that seems to be the next big thing, whether it's at very high valuations at an early stage or when it seems a bit more proven and it's an even higher valuation, they still want to participate in it because, for instance, if the belief is, hey, they're looking for the next $100 billion company or the next $1 trillion company, because that's perhaps the new way in venture thinks. Venture is no longer confined to thinking in terms of unicorns. It thinks, hey, I want to look for the next $100 billion company. Then perhaps entering at $1 billion valuation also somehow makes sense if you catch the right company.
Sounds very Tiger Global to me.
Correct. So that's one possible way, even if you have a $200 million fund, where typically a $200 million fund most likely would enter at a Series A stage or a seed or Series A stage. But now, when I say seed or Series A, I'm thinking traditional VC style valuations, right? So, and the reason it's important to clarify is these days there's a bit of a disconnect between these stages and the valuations for certain sectors. But the argument might be, hey, you know what? The only companies that win have a completely different trajectory of valuation increase. So if we miss them at an early stage, we need to join them along even at a post-billion-dollar valuation and ride that wave. That's one way. The second way is which unfortunately has also historically been true for VC.
Can you actually play that game if you have like 300 or 500 million per fund?
Not necessarily. There's not too many precedents of that. The more common thing that actually ends up happening, unfortunately, in VC is if you have one company that seems to be the new winner or the next big thing, and if you've missed that boat, you back the other one. I don't want to say copycat or clone, but maybe the second or third best company, so that you still feel you're part of the race, right? And unfortunately, most of the times, which is an interesting dynamic we haven't specifically mentioned in this episode, in these very large sort of outcome games, many a time it's a winner take all dynamic as well. So it's not good enough to back the second or third sometimes, or at least not as rewarding, nowhere near as rewarding. So then they kind of join that bandwagon that way, and quite often it doesn't go so well. That's usually the most common thing that has happened in VC. You kind of chase opportunities thinking that it's okay to back like a follower in the race, and you'll get somewhere there. I guess there's a possibility, which is perhaps what you might be alluding to, of a third game to be played, where you choose to play an entirely different game. You're not chasing the opportunities, which could be the next $100 billion company.
So I do think there's going to be the creation of a new type of venture asset class. Before I explain what I mean by that, so these middle of the road kind of players are by fund too large to live with small outcomes. It doesn't work. You literally have to have one decacorn or two to mostly 3 unicorns as an outcome. And that's unfortunately reality when you're raising that much money per fund. But you will not find a lot of follow-on capital for that, because the follow-on capital now is becoming interested in concentrating their money into fewer and fewer, even more asymmetric companies. That is a big implication of this whole thing. And that's how this bifurcation differs from 2020 and 2021. I just want to point this out, Shub. In 2020 and 2021, we had mega large funds, we had middle of the road funds, we had early funds, we had specialists, all of it. But you know what was really easy? Raising money. It was easy for founders, but it was also easy for the funds that were shareholders to get markups in their portfolio. It literally happened at an insane clip, because at the time, large funds and the ones that were driving growth rounds, follow-on rounds, weren't yet optimizing for these trillion-dollar outcomes. They were optimizing for allocating and deploying capital and then raising more capital. But now the belief is that you can actually build the next NVIDIA and get rewarded for it. And then there will be a $10 trillion outcome, etc. So the variance has become so extreme that this is not 2020 or 2021 anymore. It's actually the opposite. It's becoming harder and harder and harder for more and more companies to raise money. If you're one of the extreme ones, it's paradoxically easier than it ever was. Yeah. But if you're not, then the variance to the bottom is also very high, which means, why I mentioned that, for these middle of the road funds in 2020 and 2021, they would still find someone else to mark their companies up. Not anymore. If you come in and you lead, let's say, a 50 million or 25 million Series A, well, you now need to have someone to do a 50 or 75 million Series B, but that will only happen actually if it still looks like a legit, this is a 10 billion outcome with potential to be 100. Yeah. There's still very few of them. Yeah. Perhaps more than ever, but still very few. So what does that do to that part of the VC market, personally, I think it probably eliminates it or at least marginalizes it. And then what I want to talk about, and that leads me into the thesis, is so there's the specialists at the front end of the funnel, right? And so different ways how to play that. You can be an angel that just, or an angel type fund that participates in a huge portfolio of companies.
Mm-hmm.
And you don't care about ownership, you don't care about valuation, just get in. I think that play will always be there, but it will not be optimized for what I'm proposing is going to happen also. Then you can be a hyper specialist that builds a more concentrated portfolio that has perhaps the thesis that there is an edge in terms of access and in terms of picking abilities. That model might actually benefit from the new asset class that I'm going to propose, but you have to gear towards it. You have to commit to it. And then there are those that historically have made a play, let me be the first one and then actually be a feeder. So the first one to lead it and then be a feeder for the top tier ones. That's going to be highly, highly rewarding and highly, highly asymmetric and risky, because if you can't pick that well and predict sort of the snowballing effect, then you might have a really shit vintage and you might be out of business in the next fund cycle. But if you actually caught one of those, you're going to be set for life. So it's also a highly rewarding type of a bet. So personally, I think the first one and the third one, so the sort of super spread angel follower and the super leading feeder type fund for the asymmetric outcomes, both of them have a place in the future, and I think they can be super rewarding. But I don't think they will actually benefit from the creation of a gap in the market and the asset class. I think it's the second fund that will, and here's what I mean. So when you play this out, what will actually not go away is the $250 million exits, $500 million exits, or $50 million exits. In fact, that is the most liquid market for exits. You and I have this joke, right? So the most liquid exit market is a seed round. And then after that, it's these type of exits. That's actually where you have a super healthy funnel of potential acquirers. It's very liquid, etc. You know who will not play there? Everybody that goes down the hypervariance, hyper asymmetric investment route, because for them, it will just not be good enough. Now, that was theoretically always true for VC, because founders have been advised that, hey, once you take rocket fuel, they expect you to build a rocket. But the expectation of what a rocket is it's 100 to 1,000 times different now than it was in 2020 or 2021. In 2020, they gave you 50 million and they could live with an outcome that is literally 250 million exit, because the game was a different one. It was about capital absorption, deployment absorption. Not the case anymore. If you can't credibly say how you're building a $100 billion business, they will just not give you the money to build a 250 million exit. It's just not going to happen. Which means it creates a gap in the market for every founder and every business that could legit build a 250 million outcome. Now, perhaps the thesis is these companies will not exist anymore. These exits will not exist anymore. Everything will accumulate. Every value creation, every software-led solution will just aggregate in the hyper large outcomes. If that's what you believe, then the gap I'm proposing will not exist. If you don't believe that, the gap will exist and it will actually get orphaned. And that means that there is a ton of value that can be captured by empowering founders that go after the 200, 300, 500 million type exits. Does that make sense, Shub?
It does. It does. I think it makes a ton of sense. I think the one follow-up question I have in mind, and this is something you and I have grappled with on a tactical basis when we evaluate deals, right? So let's say hypothetically, by the way, just to clarify, that is not quite necessarily fundamental strategy, but hypothetically, if this were to be the strategy of a fund, that's the market gap they intend to exploit. In order to effectuate this exit at a 250 to 500 million, you need to access certain capital or certain other access along the way to get there. Any thoughts on if this is the new order of the venture ecosystem or the venture landscape, what's the path to chart in order to make that a bit smoother to effectuate this exit?
Yeah, you set me up perfectly. I think there's two ways how this new asset class within venture, the 250 to 500 exit asset class, will play out. So I think the first one is And sorry, by the way, for both, you need to dedicate to the strategy, which is exactly my point. Anyone that is actually doing the other strategies will not structurally be able to go after this market. So the first one is that you might actually play it closer to a PE, meaning
That was exactly the thought on my mind.
yeah. So you're raising maybe 200 million, but you're also ending up with 50% of ownership. Not at a start, but because you're the one that drives the follow-ons in the company as it is deserving. That would actually be a very good strategy, in my opinion. So if you have, I mean, think about it. If you have deployed maybe 25 million into a 250 million outcome, that's very capital efficient, actually. That's really good. What it takes away is, it doesn't necessarily take it away because you can still have sort of asymmetric outcomes. It's not like magically everything is kept at 250, so it's not like that. But you're most likely taking away the 100 trillion, 1 trillion, 10 trillion, 100 billion types of outcomes. So that yes. So that would be one way to do it. You're literally keeping funding the companies, and that's PE. It's tech PE, just perhaps in this new type of asset class. So that's one way to do it. And the other one is actually the more people do it that way, you might now create again a liquid venture capital asset class that looks like the one in 2010. It just ignores the rest. You know what I mean? So that's why I call it, this gap creates a new asset class, a new venture type, and that in itself will have, if this plays out, its own ecosystem of capital. So now perhaps we don't call it venture capital, perhaps now we call it sub-venture capital or something else.
Do you think there's a possibility where, we have these two stratified strategies going on, and then fund managers who tried their hand at the more asymmetric style but failed, and unfortunately it's an inevitability that most of them will have poor returns getting that, because there's only so many winners you can get, will then try their hand at this strategy. By this I mean the private equity, the sub-venture strategy as you coined it, and that will make it, again, the capital builds up there in a form where, again, the expectation increases to wanting unicorn plus outcomes?
I mean, I don't have a crystal ball. It's logical to think that way. I follow your train of thought. I don't know. I think what would at least delay that effect is that with the funds that you raise that are perhaps too large, structurally you still wouldn't want to compete in this. Yes. So you would swing for the fences, right? So you would still go for the ultra large, long dated call options, and actually the less substance you have in your portfolio, so that as you realize that, you will take even bigger swings with the remaining checks that you have. So you wouldn't gravitate with that fund into that part of the market. You would take even more extreme swings to sort of save your portfolio.
Right? Yeah, I mean, we haven't even gone into, specific nuances of fund managers and so on. I mean, I guess if you do present yourself as a venture fund, you get to access different pools of capital depending on the stories you present. And I think going from the more asymmetric to the sub-venture, I think it's not the prettiest of transitions to make.
Yeah. So I find this quite interesting. What I haven't thought through yet is whether venture is then actually the correct product to help this new asset class, or maybe it is debt, maybe it's debt/loans, etc. That's something else to think about. But I just find it absolutely fascinating how this gap will create a new type of asset class for founders and investors. You and I have recently looked a lot into robotics markets, and what we realized is actually that whenever projects get involved, and on the other side of the spectrum, you have more and more growth appetite, what tends to happen is that the companies that need to grow need to think like a PE. They need to standardize, like a PE that rolls up companies. They need to standardize, they need to serialize, they need to productize, and then they're actually leaving the market that they wanted to play in, which means that the old market isn't being served anymore. I'm saying it's the exact same thing. So the players that want to allocate and absorb more capital need to leave this market. This is what I'm saying. Yeah. It doesn't mean that the market is dead. It just means they're leaving it.
Yeah, I agree. I think all the logical trains of thought certainly seem to point in this direction. I think it'll be interesting to see how some of the companies which today are poised to be, the next trillion-dollar companies, etc. Once the dust settles and once it's clearer what the outcome looks like with them, where that leaves all the participants, will people be happy with having taken this race? In that case, it'll even further the, I guess, extremes that we're seeing in the asymmetric side. And that may also maybe push few folks out who have not managed to make any meaningful outcomes from it.
Yeah. So I think if you're a fund manager, you need to just see, hey, what is the strategy of my next fund that I need to raise for? And if it's not clearly geared towards this gap, you probably won't dabble in it. It doesn't work that way. And then if you're a founder, this could actually create a new type of opportunity where you can very clearly gear your company towards that kind of an outcome and work specifically with the kinds of investors along the way towards that outcome.
Yeah, absolutely.
Great. Let's see what happens.
Nice. Popcorn time, sir.
Cool. Happy weekend, Shub.
Happy weekend, sir.